Hey traders out there in Traderland, D7 here with Grok Trade, and I have a major warning to share with everybody. I'm going to get into this video. I just got off of COVID. COVID hit me hard this week. Woo! With that said, let's get going here. I'm looking at the S&P 500. This is the Spider ETF. On the daily chart, if you look at this, I'm going to go to a line chart and not looking at candlesticks. If you look at this, we had a high back here, and this was in the middle of the July. We're at the tail end of August, and we're coming up to that high right now. Normally, you come up to those highs, you hit, you drop. That's what we're looking at. What an insane rally we received, guys! Man, the market started falling out of bed. If you go, let me show you this. Let's zoom this dude in, okay? This is a daily chart on the ETF spiders, okay? Now, Thursday, major sell-off. Now, we went up, up, up. Now, follow me here, okay, guys? Follow me. Let's go candlestick by candlestick. This is something we do in our mentorship, so hopefully that's my phone going off. All right, so we were going up here on this is the S&P 500, guys. Up here, we hit our head at this resistance area. We drop. We do a little pullback. We drop again. We try to do a bigger pullback, and then we really drop. Extra bonus points if you can tell me what that is. I'll just tell you it's a bearish engulfing pattern, with this little bear flag, bearish engulfing pattern, and then we drop, but we're at support. So you can see we even have a bigger bear flag here. Do you guys see it? Bigger bear flag. And then when it dropped, it was a gap down. That shows strength, breaking down from the moving averages and that support line. We go down, gap down, and then a run up. And then we run up again, and then we have this. Now, after this engulfing, we should drop again, okay? That's what should happen. However, the bulls came back in, it goes higher, all right? Now, I'm getting to something here. So we go higher. So this is a great reward to risk ratio, bear pullback, because we were dropping on bigger volume than what we're going up, smaller volume, all textbook so far. And then there is a little doji, kind of a spinning top or an evening star is what we're seeing here. And our reward to risk ratio is significantly in our favor. We have the declining moving averages now acting as resistance. We are in a downtrend. We have lower swing highs, lower swing lows. This is a great place to be looking for a possible short, but that happened. Do you see that? That happened. That day, the day of August 13th, said, whoa, the Bears aren't going to have a shot here. The Bears had their lunches ate, okay? And those bulls took control on that day because that was a classic bear pullback. That was a short opportunity. Now, our students would have never gotten into that because we didn't go lower by a certain percentage and amount that we look for, we calculate for. And we get this. Now, chances are we could have perhaps, because we're very extended and volume is still decreasing, maybe a short opportunity here, a little more risk if we were to take it. But there, again, when we had a short opportunity, it didn't give us a lower low. It actually gapped higher. Now, at this point, this is huge. The trend line that we had here, it went higher than that. So it gapped at that trend line. Market makers, specialists, open the market 4 points to any candlestick or any day. A high, a low, open, close. There's only one that can be manipulated. The highs aren't manipulated. The bulls make the highs. The lows aren't manipulated. The bears make the lows. And the close is whoever wins between the bulls and the bears. The only one of those four that can be manipulated is the open. Market maker specialists do that at the exchanges. They opened it right at the trend line. Why? Because that is where all the orders are potentially placed. More orders that trigger, the more money they make, because they make their money off of trades through the bid and the ask price. That was too much information. I didn't mean to share all that. Okay, but next we go higher. It's a rubber band stretching higher and higher and higher. We go higher. This is an insane rally to the upside with no pullback. We've gone up 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days or 11 trading days. And then we get a doji. Huge chance of a sell-off, especially after such a rubber band stretch to the upside. A great short opportunity, but with a ton of risk because now you don't have... There's a number of things. So all you Grok grads, you know what I'm talking about. This probably wouldn't be a trade we would take. Or if we did, we would do it with different money management or risk management parameters. But then we have a drop and then we get a spinning top. Or it's not even a spinning top. This is just a hammer at the top of a thing. So it's called a hanging man, the technical term. It'd be better if there was no body on that, but you can still say, actually with the body is fine. It's a hanging man. That's a reversal pattern. Here is, again, a short opportunity. And there it is, a major sell-off, guys. A major sell-off. That sell-off happened, and we should have just started dropping and giving back about half of all this gain. We should have come right back down. But what happened was on Friday, we rallied higher again. Now, why did we rally higher? Because the Fed came out saying, okay, it's about time. We are forced to say we are going to be lowering rates. For that reason, they were at a point that if they hadn't said that Thursday, when Thursday showed that bloodbath on big volume, by the way, this big tick on volume, that was going to be the cascading effect. That was going to be the thing that's going to bring things down. And the question is, how bad was that going to be? They were forced. And I've seen this, let's say, recession seasons after recession season, when the markets are at a place where you could see it just getting ready to fall off the edge, the Fed will come out and say something to keep the markets higher. And we saw it again on Friday. Fascinating. Or Thursday night, or however that played out. Now, the question is, where are we technically? Because the thing is, you don't want to try to figure out the news. You don't want to try to figure out what's going to happen because of the economics per se. What you want to do is look at the technicals. Why? Because technicals is price action. Technicals bring in raw data. That raw data of price allows us to quantify reality. In other words, whatever is reality in the markets right now and what the markets are perceiving or reacting to, what forces that are out there, will be shown as a footprint in price action on the chart. So whoever looks at these the best wins. Whoever trades using the charts and understands the technical analysis the best wins over everybody else that are sub-educated. So specialized knowledge is very important, especially in the area of finance. So keep that in mind. Maybe reverse that, listen to that again. Okay. That was a mentor moment. If you didn't know what a mentoring was, that was a mentor moment I just went through. And that was a good 5 minutes worth of mentoring. Anyway, there it is. But look at the Dow. We are right at the previous high area right now on the daily chart. What should happen? What should happen here? This is going to be a hard area to try to be going long, especially after such an extended level up. I'm going to be showing you something that's no fun for the bulls here soon. If you look at the Qs, we are not nearly as high. We're not near the highs as we were seeing on the diamonds, okay? This is the techs. Techs are relatively weaker. If you look at the spider, it's at the previous highs. You look at the diamonds, previous highs. But the techs, not at the previous highs. The Russell 2000, which is small caps, lower. But look at the huge pop on major volume. So that's a check mark in the bull section. But we're relatively weaker than everybody else. And that's it. But financials, what is fascinating here, guys, financials are beyond the area. It's relatively stronger than everything else. But the big problem financials have is it is at a major area of resistance. Boys and girls, what is interesting on this is the candlestick went higher and come back down and closed right at that line. Why? Because that line is valid. This line is a serious line. Big extension. Went up, base, up, right at resistance. This dude is dying to pull back about 50% of this. So next week could be a nasty little sell-off in the markets. However, you got the Fed promising these lower rates, okay? This is going to be so interesting. The Feds are coming in and messing up traditional technical analysis, what we're seeing, or they could be, because right now we should be dropping really soon. U.S. dollar says a lot. U.S. dollar has been falling out a bit. I'm going to bring in some indicators. Look at this. We're down. This is the RSI, this purple band here. Anything below the purple band means it's relatively way oversold. And the last time we got near that, getting below that purple line, U.S. dollar rallied higher, which is really usually bad for gold and silver, usually bad for the markets. And down here, if you look at this, I'm gotta move some things that you don't see, but it's there. Last time we were down here, you see this, U.S. dollar, rallied strongly. So we're there again. The U.S. dollar should be rallying strongly here soon. That means the U.S. dollar is going to rally up. The reason gold and silver has been so high, guys, because the U.S. dollar has been so low. Look at the gold, up. Last week, all-time highs. We're at major resistance here. If you look at this, we're in a rising wedge. We're at resistance areas. If the U.S. dollar rallies, you're going to see gold drop. Silver should do the same thing. We're in a big symmetrical triangle. This thing is oscillating inside a huge symmetrical triangle. You can see the moving averages starting to coil together there. That's my phone. If you guys use Android, you'll know that sound. And VIX, if you look at this, the VIX is not under 15 anymore, but it's under 16. Last week, we did go higher, but Friday, we did drop back down. We're seeing that we're making higher swing lows. So we are going in the wrong direction on fear. Fear is starting to trend upwards. People are seeing this. I want to do a quick look while we're here at a couple tech stocks, because you guys geek out on the tech stocks. We'll go here to tech. This is Apple. If you look at Apple, these lines are drawn very, very correctly. It looks like they are wrong, and I'm scientific when it comes to this. It's no art to this. This is all science on how to draw these. And when you draw them, if you put a line chart, you'll see they are spot on. That is highly important to us, that they're drawn correctly. And up. The question is this a high base ready to take its breath and to rally higher? It could be on Apple, or this thing is it's petering out. And if it drops below these moving averages, look for this to get back down to this line again, and then look for this to potentially drop lower. AMD, if you look at this, up in the moving averages, up. This thing looks, like it's toppy. Amazon, if you look at this, down, up, bear pullback, big drop, up, bear pullback. This is a big bear pullback. It filled the gap. Selling should commence. Quick look at Google. Down, bear flag. It's a textbook bear flag. Look for a breakdown down to this trend line. Anything else? Meta, we'll take a look at Meta. Meta is up and chopping around. Let's see what happens there. Microsoft is up. Look at that. It got it back above this line and then dropped back below it, showing a ton of weakness. But it was a bear pullback, and now it's dropping. And Netflix, very, very strong. Very strong. That's a bull flag taking place. So I like this one on the bullish side more than anything. Same thing, big high base. But the problem with the high base on Nvidia, this high base that we're building, is we have higher highs right before it. That's going to be huge problems for this. This is not the best high base. It's a pretty high base, not the best because of location. And that's it. I'll look at there. So let's get into my monologue. So for you guys that don't know anything about who we are and what we do, feel free to subscribe. You can always unsubscribe if you don't like the content that we deliver here. Been trading in live markets 27 years using technical analysis, 27, almost 3 decades using charts. First person in the world to be doing trading videos online. They got very popular at Trade to Win. You can find me at Des44, DES44. It's my handle, and you can see I was promoting trading videos in 2004, and that was before YouTube was even a thing. I am the founder. I did those first. Hard to believe. I'm an award-winning stock mentor for Rich Dad, Poor Dad, Robert Kiyosaki. Been with them for several years, and now I have my own company. But here are the things that I am really concerned about in the markets. I'm going to give you two things why I don't think the markets are ready quite yet. It's going to bring a lot of turbulence. Here it is. Number one. It feels like a recession out there right now. I think you guys agree with that. Feels like a recession. They have revised unemployment rates, and I'm down by, 818,000. Unemployment is lower, or new jobs are lower than what they were reported initially. GDP, 30 to 50% of GDP. 30% of GDP is government spending. Upwards of up to 50% is government spending, plus people and things that are government influenced or connected. So 50% of the GDP has the government touching it in some way, shape, or form. If you were to take the government out and cut the GDP in half, that would be problematic. But here's the thing. We have a couple things that are a concern. And number one thing that's of concern is, are we going to correct ourselves on the bond yield inversion? So very important that we look at this. We are getting very close, very, very close to correcting ourselves on the bond yield inversion. In other words, 100% of the time, anytime we had a bond yield inversion, we've had a recession, a recessionary pullback in the markets. And we have been in one of those very rare bond yield inversions for the longest time and deeper than what we've ever experienced in history before. Fascinating. We're in that environment now. What we have found is after it corrects itself is usually when the markets will start to fall out of bed. And it's usually not immediately when that happens. It's with the average is about 100 days, 3 months. So if we correct ourselves anytime soon, it could be the beginning of next year where we see the major sell-off. 2025, guys, could be a real bloody year for us. And I'm sharing that as meaning it's just due for it. Recessions come, they happen. And it could be 18 to 24 months of just pure retracement. Okay, now, the SOM rule says that we are already in a recession. It's been very reliable, so there we are. Why do I not think that the top is maybe not put in yet? Here's why. I don't see capitulation in volume. Usually we see huge volume on big buying volume, big selling volume, big chops. We're not seeing capitulation yet. The other thing we haven't seen yet is a negative GDP. Now, is it being influenced? Is it being manipulated in any way, shape, or form? Maybe, I don't know. I can't speculate on that. Now, what I can say is usually it's considered we're in a recession when a recession or when a GDP decreases by 2 quarters in a row, two negative GDPs, quarter over quarter, 2 in a row. What I'm speculating is if we start to see capitulation, what will come first, a negative GDP or capitulation? And if we see, so maybe the GDP will spawn capitulation in the markets, a negative GDP. So our first negative GDP could be the nasty top that we're looking for, and then we will see a second negative GDP and a third potentially. Okay, if we were to see that, then that would be the big drops that we will see in the markets that will start to accumulate and make it commence. So that's what we're looking for. So we're not seeing those yet. We're keeping a close eye on the markets. And this is something that I think and I hope that you'll lock arms with us to watch this with us. So watching this with us will be very important. Technical side of things, we're fairly experienced at this. Like I said, been trading using technical analysis 27 years and been mentoring, since 2004. Yeah, about the time I started my trading videos. I started mentoring in 2004, and I've mentored thousands of people now, and in our company, thousands of people. Anyway, that's it. That's the long and short of it. What I would say is it would be hard pressed for me to want to be completely long in the markets. Cash is probably king today, but if you're going to be trading in the markets, especially swing trading, maybe look to preserve profits, get your stop losses, get to break even quicker than normal. Give it less breathing room, take profits sooner than later, and be happy with any profits that you do get. Don't get greedy. Greed is one of the big two that will come in and kill a person's momentum or longevity in the markets. Okay, so don't let that be you. So anyway, if I've earned a like, give me a like. Doesn't cost you anything to hit like. Doesn't cost you a thing to hit. So give that to me. If you made it to this point, you are a crazy man or woman. There's a 85% chance you are a male, 15% chance you are female watching this. We know that statistically speaking. And if you're a female watching this, you're probably high on the totem pole at your job place. In other words, you're either a business owner or one of the executives, because that's you females are the ones that usually come through my program. And there's probably a lot of lefties here and a lot of pilots in this, listening to this. And furthermore, a ton of engineers. If you're an engineer, oh boy, you're tuning in. So appreciate you guys. Love you all. Take care. And I'm telling you, COVID hit me again. And that is it. If you made it this far, say made it. But COVID got me again. I lost my taste, my smell. It's starting to come back already, and I'm about 7 days into this thing. I'm on the tail end, but it wiped me out in bed and the couch for a few days. Craziness. But if you made it this far, say made it down in the comments. You and I will know what that means. Take care. Catch you later. Bye. Guys, why are you still here? You just watched my video and now you're still lingering around. Might as well be with you now that I have your undivided attention. Listen, if you haven't done so yet, I highly recommend putting in a foundation of trading, your foundation of trading through a mentor. For learning to fly a plane, you wouldn't just go through ground school before you start flying in the friendly skies. What you would be doing, though, is going up first with your flight instructor. Same thing if you're going to learn to ride a bike, you better have somebody behind you helping you ride a bike. Surgery, you're not going to read a few books and do heart surgery. So every principle and with being guided by a mentor, let finances be this. If you are a trader, you rate you from amateurs to professionals. Mentoring will do that for you. Anyway.